size, but that looks perfect, you know. We managed this quite well. So welcome tonight for a co-organized event by the Crypto Valley Association and Bitcoin Suisse. I'm Jérôme Bailly, I'm the president of the Crypto Valley Association, and I'm really happy to see all of you tonight for a very exciting evening where you will learn a lot. I hope you will appreciate the event. It's now kind of a tradition that we all co-organize this event with Bitcoin Suisse at the end of the year to talk about the Crypto Outlook report that you produce for the 7th time, I think. Congratulations. We already had the chance to do several events together. It's always very interesting. So we will have tonight the presentation of the report followed by a panel. So I want to thank all the speakers from Bitcoin Suisse, from the Bitcoin Standard Treasury Company, and also for Bitwise. Just want to say a few words to Bitwise. Thank you for joining Bitwise, the Crypto Valley Association, as a corporate member. It's one of the newest members, so you're welcome to the community. Very excited to have you. You were there already last week for our next event, and already received a confirmation that you will be there for our next event. So thank you very much, Bitwise, for joining the community. I won't be long, because the real information, real insights will be after. But as it's an event when we launch of your report, we also launch the communication about our next flagship event, which is called the Web3 Banking Symposium. So that's the first time that the Crypto Valley Association organized a flagship event in Zurich. Save the date, March the 2nd, 2026. This one is different to the Crypto Valley Conference. I hope you all know the CVC, longest running crypto conference in Europe. This one is really focused to banking and institutional. We had the chance to test the format two years in a row. Last year we were in Geneva, and this year we were in Lugano. Some of you were with us. And so next year we are ready to be where everything happens in Switzerland when it comes to banking, meaning Zurich. We already had a lot of participants. You see a lot of institutional and banking logos. I hope you will be one of them for the 2026. A few focus area will be stablecoin, international payment, new rails for B2B payment, asset tokenization, real-world asset tokenization, banking infrastructure, how we integrate Web3, and new product offering. Really high-level focus area. And I think something you will like. We have decided to do something in a very unusual place. We focus on experience, and we rented the Kunsthaus Museum in Zurich, which is if you're from Zurich, you know it. That's quite a beautiful area. So we have the whole museum for us, a lot of experience on art also for networking. So I really encourage you to save the date, join us as an attendee, and maybe join us as a sponsor, because yes, we need sponsors. We already have a few sponsors that already have been taken. I can already share you informally that the presenting partner of the Web3 Banking Symposium 2026 will be Franklin Templeton. Thank you for their trust. They joined us last year as a corporate member. We had the chance to meet Jen Johnson, their CEO, and they will help us for the organization of this one. But still plenty of opportunity to put your brand and company up front. Get in touch with us, get in touch with me and any CVA members who are working in the committee. Then, before ending, I just really want to do a special thank you to Bitcoin Suisse, because Bitcoin Suisse has been one of the founding members of the Crypto Valley Association back in 2017. One of the few company who believed in this association and who's been there with us every year. Like each time we need support, we know we call Bitcoin Suisse and they are there. So it's really something that I wanted to emphasize, and I wanted to thank all the Bitcoin Suisse team here, and especially Peter. Thank you for your support. It's really, really important for us. And last point, a small announcement, but also to confirm that we value this relationship. So we have formally agreed that the crypto holdings of the Crypto Valley Association will now be at the custody of Bitcoin Suisse. So that's the first time that we move the holdings of the association, and we decided to do it with one of our special members. So thank you very much for the opportunity, and we look forward to 2026 together. And now I want to introduce Peter Camenzind, who is the new CEO of Bitcoin Suisse. So first of all, congratulations for your new role, and I invite you to say a few words in the name of your company.
Thank you for your kind work. Moving the funds into the custody of Bitcoin Suisse is maybe the best idea we were here today. So thank you very much. So I think Bitcoin Suisse requires no lengthy introduction. We have been not only part of the Crypto Valley, but maybe the main address of Crypto Valley since 2013. And what since 2013 our clients want from us is a clear opinion. So not only a clear opinion, but they want us to be the opinion leaders in the field. And whereas in TradFi, the economists and analysts and researchers often build their outlook around consensus, it's no such thing as consensus in our world, in the crypto world. So our predictions and our calls in the past have been quite bold, and it is extremely interesting and makes me proud to see, despite the boldness of it, how accurate we have been in the past, with an accuracy rate of 80% in 24, now 75% in 25. I'm really looking forward to hear and see your calls for 26. I wish us all an interesting and insightful hour. And with that, I pass the floor to you. Thank you very much.
That's the mic. I think I take the mic. Thank you, Peter, for the intro. Also, Jérôme and the CVA for hosting this with us. I can just echo what you said. I think we also deeply value the partnership with the CVA. But now we are heading into Outlook content. So officially also welcome from my side to this year's 26 Outlook event. I'm Dominic Weibel, I'm heading the research department at Bitcoin Suisse. Presenting with me today is Denis Oevermann, our investment strategist. And obviously we are both very excited to share our recent research and insights with you. But that's not all. Afterwards, we have a super high-end quality panel, including André and Jean-Bill from both Bitwise and the Bitcoin Standard Treasury Company. So there's more to look out for after this presentation. The Outlook, as Peter briefly mentioned, it's our flagship publication, and in it we outline what we expect in the year ahead, in terms of trends, in terms of macro developments, but also in terms of potential threats, both for crypto markets, but also the underlying technology. And Peter also mentioned we did quite well in the last couple of years, and obviously we try to do that again in 26. Before we dive into the forward-looking content, I want to take a brief look into the rear view mirror. This is our periodic table of asset classes. Sorry, in the back we can share the slides afterwards if you can't see this. But I want your attention basically on the right-hand column. It shows you the year-to-date performance across different asset classes. And what is striking, obviously, if you look at the top, gold outperformed all asset classes. It returned roughly 60% year-to-date. And then the follow-ups, tech equity, AI, the S&P also performed remarkably well, around the 20% mark. On the opposing side, basically rather flat and trading in the basement of these columns are crypto assets. So crypto assets really surprised to the downside this year, although they usually rally alongside risk assets such as the S&P. So we are framing this year as crypto really over-delivered on fundamentals and heavily under-delivered on the price. And there's a basket of reasons. If you think about the AI narrative, it was very strong. Gold rally was very strong with the debasement trade. Stablecoins, Tether bought like more gold than anybody else in Q2 and Q3. We had like major retail participation in the buying gold, and AI also the earnings often surprised to the upside, meaning it's a lot of liquidity that did not end up in crypto assets, right? We know the market is very reflects it leans into narratives. And this year, it just wasn't the crypto wasn't just a big topic. At the same time, we know there was some form of front running of the notorious 4-year cycle. Then we broke this year this psychological barrier of 100K. This basically prompted many long-term holders to de-risk some, take some exposure off, distribute some of their holdings. We also know in this cycle, it was one of the few cycles where we did not see any retail mania like at all. No blow-off tops, which also means to us, if there's no blow-off and mania to the upside, there might not be capitulation to the downside. So the cycles are somewhat changing. Mostly this cycle was driven by institutional flows, DATs for instance, ETFs, very strong flows, while the retail part was very muted. We are very constructive on 26, and we outline now why we believe 26 might surprise maybe to the upside. We basically structured this presentation into 4 different areas. We start a little bit with like outlining how we believe that capital flows, how you allocate into crypto will develop in the next year. Then we will outline how we believe that infrastructure and protocols will evolve, mostly in terms of adoption. And then afterwards, Denis will follow up and basically cover the macro framework, and then our like beloved directional calls. Everybody wants price targets, right? We start with the crypto flows. One of our big calls for next year is that we do believe that ETFs will see their second major act. This bar chart basically shows you, it's a recent Schwab survey outlining how investors plan to allocate into different asset classes and ETFs. And what is really like very impressive is that cryptocurrencies range second with 45%, like basically on par with bonds. At the same time, bonds have 45% of assets under management, crypto just 1%, implying that there's a lot of capital influx in 26. Now, at the same time, on the institutional front, we know that this long-term holdout vanguard is now opening up to crypto, meaning like 7 to 8 million people are now able to allocate into crypto. At the same time, Bank of America is also now allowing their advisors to allocate into crypto, meaning we are unlocking a multi-trillion capital pool. Then in August, if you remember, there was this executive order now also opening up retirement accounts to allocate into crypto, which is another 9 trillion pool. You could also add, for instance, the crypto wealth transfer from older generations to younger. For instance, people above 70 years now in the US now hold 33% of the entire wealth. So this is distributed at some point to generations that resonate even more with crypto. So we expect like there are really strong institutional flows in 26. And at the same time, also sovereign allocators are warming up. If you think about the Czech National Bank recently, Luxembourg, Abu Dhabi, you name it. So one of the calls is that at the end of 26, these passive vehicles will hold like roughly 10% of Bitcoin and 8% of ETH. And one might even argue this is very conservative almost. I just mentioned passive. We also believe in one of our first calls in the outlook that there is some form of tug of war emerging in crypto, because these ETF flows, they also tend to be very passive, price insensitive, and so forth, that we know from the traditional world, meaning that they will anchor the large caps in the top 10, like for sure. What you see in these pie charts is basically how top heavy the Nasdaq is. What you see is only 29% of this index is outside of the top 10. If you compare that to crypto, excluding Bitcoin, it feels like this chart looks very similar to the Nasdaq. But the assets outside, in terms of market capitalization, outside of the top 10 are only 20.2. If we now add our digital gold, Bitcoin, it's just 7.1%. So crypto is very, very top heavy, even way more top heavy than the Nasdaq. And we do believe these ETF flows will anchor the top line, but we also do believe that this 7.1% will increase. We will see new market breadth in crypto for this reason. What happened across the last couple of years is that we do know the revenue meter is getting more and more important, meaning we finally somewhat move away from these slot tokens and have tokens that distribute revenue to token holders. Here's a table with the top 10. Hyperliquid, for instance, in the last 30 days distributed 100 million in revenue to the token holders. So maybe you might say, finally something where I can apply discounted cash flow models and things like that. And this chart is the striking part. Now, after many years of applications being online and getting traction and so forth, they are now driving 89% of the overall revenue, meaning that just 10% is in the rest. But at the same time, blockchains do like 90% of the market cap, while they are only driving 10% of the fees and the revenue. So in our view, we do believe the ETFs will anchor the top, but we believe there's a repricing overdue, and maybe also some L1s will soften in terms of L1 premium. Staying in the market structure part, we do the next call is that we believe it's finally time in 26 that options markets substantially pick up in activity. What you see in this chart is basically indexed the relative growth of crypto options, crypto futures, and crypto spot. What we see that there is some options on a relative basis grow already faster than the rest. It's now roughly annual growth of roughly 40%. We also do hit new record volumes. For instance, in October, 250 billion. And there are like 4 major reasons why we expect that options will gain a lot of market share and eat into the market share of futures and spot. The first one is the market is maturing. More sophisticated players are entering the space, and they are hungry for options, because that's what happens in TradFi as well. Then we expect some more volatility, potentially, especially around the midterms in 26. And options is where the music plays when we are in a high volatility regime. Then we also deal or observe improved pricing models, and we have some tech stack innovation and improvements for crypto native protocols. So these will link to a relative outgrowth of options markets in our view. And here maybe just to demonstrate or make this even more tangible, on the left-hand side you see how options markets, the distribution of volume developed across the last couple of years, across actually the last 3 decades. And you see that it's absolutely dominating. And what you see on the crypto market side, on the right-hand side, options are tiny. Like you almost don't see it, it's like 3%. Our call is that it grows to roughly 5% in the next year, and from there it will be potentially up only. Also, you have like very more sophisticated tools. We are also expecting that perpetual options will also pick up in terms of adoption. Now we are briefly diving into rails and resilience, so more the infrastructure part. one of the deepest and most important topics are stablecoins. Especially with Genius now, we know stablecoins supply is at an all-time high. It's the first cycle where stablecoins decoupled from the underlying crypto cycle, implying there's like a lot of utility. We know there's like 120 billion in annualized payment flows right now across B2B, peer-to-peer, card-linked payments, and so forth. Yet, this entire industry, this entire area is hugely dominated by just Tether and Circle. They do like 86% of the supply is from Tether and Circle alone. Our call is that this duopoly will weaken in 26. We are calling at least for 75% as we move into a multi-issuer landscape. And we do believe that this duopoly will also end at some point. The reason is we have more regulatory clarity. The other reason is we know Tether and Circle, they do hold 250 billion in reserves. They make a 2-digit billion in profit on these reserves. And other companies do want part of the cake. Tether is the most profitable company per employee globally. And all of these like fintechs, banks and so forth are waking up to that fact, and they want part of this stablecoin supply chain. And now with the Genius Act, we know that tech companies might start to challenge banks, and that stablecoins might start to challenge bank deposits. So if you think about the news, Klarna is involved, Amazon, Walmart is considering it. We have a PayPal stablecoin already. We know SocGen, Stripe is launching Tempo with huge partnerships, among them Anthropic. And then from the crypto native side, they are also getting cornered. We know Hyperliquid is launching their own stablecoin. MegaETH is launching their own stablecoin. They all want to tap into this carry. Therefore, we believe that the duopoly will basically substantially weaken. And another aspect is, if you think about the regulation, isn't it weird that both Mika and Genius ask for prohibition of yield distribution? So in our view, Tether and Circle will not only be cornered by the entities I mentioned before, but it will also be cornered by smart entities that just work around basically and come up with yield-bearing stablecoins. What we see is yield-bearing stablecoins are now almost 13 billion, roughly 4.3% of the supply. And in terms of a relative growth aspect, they are growing way faster than payment stablecoins. Payment stablecoins meaning they do not distribute any yield. And we as a customer, obviously we want access to that yield. Genius, for instance, it has a small loophole where you can provide yield as a third party or rewards. And they are actually, the banking lobby is challenging this right now within the market structure bill, although it has nothing to do with stablecoin actually. So we do believe that regulation will force this two-way lane market where we have these compliant payment dollars. These are challenged, and then like Tether and Circle, and it will also be challenged by yield-bearing stablecoins. It can be whatever yield wrapper. It can be a strategy wrapped into a pegged dollar, for instance. Then just briefly, we do believe that Polymarket is getting crowned as the prediction market king. Right now it's still Kalshi. If you check the volumes here, Kalshi is slightly dominating the prediction markets. We know prediction markets 25 was really the year where prediction markets crossed into mainstream relevance. If you check the volume chart, this was around the US elections. Afterwards it dropped, fair enough. But now there's genuine traction. So there's like sticky user retention and a lot of users just very keen to play around with prediction markets. And it clearly proved during 25 that prediction markets are not a one-trick pony or a one-hit wonder. It's here to stay, and it's only becoming more relevant. Although for this entire time Polymarket had no access to the US markets, and it's the most capital-heavy market. This is changing right now. We also know there's like major partnerships, including a ICE investment, which is like really implying a lot of institutional confidence. And strikingly, this gray bar of Calci, 50% of the volume of Calci is driven by a Robinhood partnership. And Robinhood is now exiting this partnership because they want to launch their own prediction market. So strong arguments that Polymarket will overtake Calci. And I thought this chart is also quite interesting. You see basically across which sectors the activity is distributed in both prediction markets. And you see Polymarket is quite equally distributed across crypto, sports and so forth. It's definitely the more crypto native platform, and Calci is like heavily anchored into sports. So if you think about it, it's way easier for Polymarket to gain market share than it is for Calci. The Calci basically the onshore non-crypto native player, and Polymarket more the offshore crypto native player. Then lastly, this is something that André might like as well. We do believe 26 should shape up as a year where the community is seriously considering how they want to approach the quantum threat. We know that in the last couple of months there was like huge progress in terms of quantum. The timelines are compressing faster than we can blink. It becomes like really a tangible threat. There are like estimates that we deal with a quantum ready computer by 2030. And if you think about like high level low hanging fruits in terms of targets, blockchains are very the earliest basically high value target, because you can harvest public keys now, like exposed public keys. It depends on your address type, and then basically attack them later. The challenge, I'm very sorry. So let's go back to the quantum topic. So I said that blockchain are really the earliest high value target, because you can basically farm exposed public keys, basically attack them later. And as of now, as you see here in this chart, you have two different types here. At risk due to unsafe address type, and then at risk due to reused addresses. Both basically mean that the public key in some form might be visible, and you can basically then derive the private key with a sufficiently powerful quantum computer from that public key. In our view, 26 is really the year where the community has to start figuring out and digging deep on how to deal with it. We have a couple of Bitcoin improvement proposals already. I think the traction is quite strong already, and it's important because we know that Bitcoin is highly ossified. It takes a lot of time if you want to get consensus on a soft or hard fork, and definitely if you look at the timelines, 26 has to be the year where we start like forming some form of consensus. That means 26 initiates the soft fork path in our view, and it's a very positive development, because as I mentioned earlier, the quantum threats are just very strongly compressing in timelines. I think it will be a good topic later on the panel as well. And now we head over into the macro framework and into the directional calls. Thanks everybody for the attention.
I was already worried Dominic might cut off the price predictions with the laptop there. So, where are we in 2025? It's been a volatile year. I would still say it's been quite a bullish and positive year overall for the crypto industry. As Dominic mentioned, price-wise, we've been looking quite bleak at the end of the year, comparably maybe to gold or even to silver, which doubled year over year. But if we zoom out a little bit in terms of where are we with the cycles overall, with the economy, with the markets, what we can generally say, of course, is that the business cycle overall has fairly stabilized over the recent years. Meaning, of course, usually once we see economic downturns, in the past we've also seen a recession, there's been major corrections in the markets, but so far what we saw actually during 2025, especially also with the tariff backdrop in the markets, was stabilization across the board, right? We know the IMF and the World Bank, they're also projecting that we are stabilizing global GDP growth at around 3.1% next year. Currently we're at 3.2%, and historically, answering maybe also that questions what many people have in the markets, right? Is there maybe now gonna be a recession year ahead? it wouldn't really look that way in the charts as of now. If we also look, for example, how's the economy doing in terms of general liquidity and financial conditions, we have the National Financial Conditions Index down here, meaning once an index rises, there's contracting liquidity and credit conditions in the market, and if it's going down, it's actually easing. And also there, what we see across the board, since roughly 2023, we see actually easing conditions in terms of liquidity access for the broader economy, which is quite striking, right? Because the Fed has been communicating quantitative tightening since 2022 as well, and only ended that as of last week. So overall, economically, what we can observe certainly is stabilization across the board and also rising sentiment and activity again, while at the same time the liquidity conditions for businesses are fairly easy. Why does that matter? Of course, because we have, let's say, anomaly in the market, one irrational player, that's of course the central bank usually, because the central banks have an impossible dual mandate, you might call it, right? On the one hand, they're obliged to cause stable prices. Stable prices means low inflation, and prices are not changing much. And on the other hand, what they should do, of course, is cause or be responsible for full employment in the economy. And that's basically an impossible mandate, because one of these two variables always comes at the cost of the other, right? You cannot have full employment and stable prices usually in the economy. Why does that matter? Of course, because post-COVID, what we saw was very much double-digit inflation rates. Maybe not in Switzerland, but if we look at Europe or also the broader US economy, double-digit inflation rates were basically on the menu. And that is also quite important, because usually high inflation causes rate hikes for the Federal Reserve or for the Federal Reserve target rate. And historically, what happens also in the meantime, usually once we see inflation rising, rates being hiked, we see that the labor market is softening and unemployment rises historically. Sorry for maybe some tall guys in the front line, especially Dominic, but down here on the unemployment rate chart, what we can see actually is that unemployment historically rose quite steeply coming into or out of a recession historically. So we know the dot-com crisis, unemployment almost doubled more or less. At the same time, global financial crisis, later also in the 2010 years, the Euro crisis, Greece, Cyprus, etc. The unemployment rate more than doubled. In post-COVID, it even tripled over the time of less than a year or maximum 2 years. If you now look where we are currently at economically and also in terms of the labor market, we saw that since 2022 and 23, the labor market weakened and the unemployment rate rose only by relatively 30% over the course of more than 2 years. So relatively stable and resilient economy overall, in our opinion. If you now look what this irrational big player in the market does, what we see, of course, is the rate has been hiked post-COVID. We came back of a target rate of almost 5%. But what's striking, of course, is once we come off of that plateau again, meaning once rates are cut and we go back into that easing regime, what happens historically in the markets? Historically, of course, rate cuts always perceived as bullish, but usually they mean the markets contract in the short term, because it also means the economy has been weakening, markets sell off. Again, if you compare the 3 prior major crises that we observed since this millennia, basically, what we can see is the rates have been cut very, very steeply in a very short period of time. So usually within a year, or even less than a year, the rate has been cut by more than half already. And in basically 1 to 2 years, the rate has been cut almost entirely from the target or from the peak Federal Reserve rate, meaning it's been cut almost to zero in a panic attempt to really restart the economy. And again, if we look, where are we coming off from now currently? After 12 months, the rate has been only cut by relative 20%. And the forward pricing, 1 year's time from now, that's also in our outlook what we address, it's currently priced at 3%, meaning the rate is not even cut in half over almost 2 years. So very, very moderate approach and a perfect soft landing scenario, which is also what we anticipate. What we now actually anticipate is that the current futures pricing in the market is wrong, and we think that the rate will actually be cut way more steeply and more towards 2% compared to the 3% that markets price in currently. Meaning, of course, that based on economic factors, higher rate cuts are warranted, but there's another irrational player in the market, which is then usually politicians, and we know, of course, that Trump would like to have the rate lower. There's also economic reasons to that, actually. If we know the US is currently running at a deficit of 6% and has to refinance 9 trillion in debt upcoming year. And if you have to refinance 9 trillion of a fiscal deficit, you'd of course like to do that at a lower interest rate. That brings us to our favorite topic and an overarching topic, which is of course the general dynamics of liquidity expansion in the market. We know liquidity expansions, they actually drive market and asset prices, And that's especially the case because assets are usually limited in supply, whereas cash is not. The past 4.5 years actually have been quite interesting, however. We know the quantitative tightening regime ended after 4.5 years by the Fed as of last week. And what that means, of course, is that global net liquidity, so what central banks actually hold on balance sheet, meaning buying and selling off assets, has contracted by 8 trillion over the past 4.5 years, all while the broad money expansion underwent basically to the upside by more than 10 trillion over the same time. Why does it matter? We know, of course, that global M2, so the broad money base, is more of an economic supply liquidity indicator, whereas the global net liquidity means what are central banks directly buying in the financial markets, meaning liquidity and liquidity easing also to asset markets. That matters, of course, because if we now zoom out a little bit in terms of relative asset class performances, what we expect for the upcoming year is actually broadening rally and an economic re-acceleration. That is based furthermore by deregulation. We know there are severe tax cuts coming in the United States. Trump is going to launch his big beautiful bill soon, and that also means roughly 2 to 3 trillion in annualized spending or fiscal stimulus. And all of those indicators basically project and underline that we're coming more into an economic, fundamentally supported regime, but also a regime that is, compared to the past 4.5 years, easy in terms of lower interest rates. We know global rate cuts hit more than 300 rate cuts over the past 2 years, and at the same time, QE will slowly and gradually come back into the market. Not yet, but it will over the upcoming months, and that will also have a lagging effect in terms of liquidity available for assets. Now to the part of what does it actually mean and where does it place our favorite asset class, especially ours, which is crypto. So I start basically with our favorite chart, which means where is Bitcoin standing in terms of its cycle and what does it show in terms of risk dynamics, both price risk dynamics and on-chain risk dynamics. And what we can see is that this bull run so far has been actually one of the most boring bull runs so far, you could say, right? Volatility is all-time lows, Bitcoin hit all-time highs this year, and basically everyone is asking where's the bull run, and I say, well, Bitcoin went up more than 8 times from the bottom roughly 2.5 years ago. But what we can also observe is, of course, an increasing maturing of the asset class itself, right? So on a net basis, more than 26 billion has been bought in US ETFs for Bitcoin this year. And you might think, well, that's not a lot, and why is the price not way higher? On the other hand, actually, long-term holders and people exiting their Bitcoin positions realize more than 400 billion in net profits, meaning there's been a sales wave and sales pressure of net more than 400 billion absorbed in the market. So if you now consider you almost sell $500 billion in profits in the market, and here we are almost closing at close to 6 figures after the whole year, that is actually very, very impressive and also a sign of a maturing asset class. A bit on the short-term side, where is Bitcoin actually right now? So we came out of a, let's say, steeper correction, especially after a year of low volatility, right? Bitcoin corrected by more than 30% twice in the year. As I said, however, if you now take some on-chain valuation bands, so basically looking at true cost basis, something like realized price, balance price, meaning what is the actual cost basis at which Bitcoin has been bought and how much money truly flew into the market cap of Bitcoin, we can then derive certain valuation bands that are actually based on true market behavior and true liquidity that flew into Bitcoin. And that all-time fair value is currently at 125,000. And if you look over the past, that is roughly 2 years, what we can see is that Bitcoin traded very, very close to this fair value the entire time. And we also believe that based on past indicators, past dynamics, that this extension definitely warrants Bitcoin going higher in the upcoming year. We have that cycle target of roughly 180,000, and we also think that it's going to trade above 150,000, which, based on historical patterns, is quite likely. And we also have to contrast it with the entire bull run so far being in basically a tightening regime, compared to now more easing economic and monetary conditions. If you zoom over to Ethereum, the second largest asset, which also had tremendous traction from DATs to now more treasuries buying it, ETF inflows of more than 12 billion net. Company like Bitminer, so the pendant to MicroStrategy, now also holds 3% of all ETH supply. We see that the picture is very similar in terms of where ETH is currently in the cycle and also relatively what does the journey ahead hold. Similar here actually to Bitcoin, if you now look at how much sales pressure has ETH actually withstood throughout the year, it's almost 100 billion, which is very substantial given the market cap is not a lot larger for Ethereum. So substantial liquidity and redistribution took place over the year, and it also shows that this asset is really way more ossified and fundamentally stronger at the same price that you had actually a couple of years ago already. That means also, of course, we start out from, let's say, a more ossified fundament in terms of the price, and same story in terms of the derivation of the price bands and what is the true fair value of Ethereum right now. You can also see there that Ethereum is actually undervalued by roughly 30% relative, with the fair value being at 4,500, whereas the current price is trading in the lower 3,000s. So likewise, also for Ethereum, we think that now with the easing regime going on, that the prices will trade a lot higher, and also in terms of the risk dynamics we observe in the market, it's actually, if we go back one chart, we see that actually ETH really fully underwent this entire cycle reset in terms of the dynamics, whereas it with the adoption trend, and we also believe that there's good reason to believe that Ethereum will trade higher, which is also then our directional call. We did put out a price target for Ethereum roughly 2 years ago already. It was rather ambitious at the time. It was actually hitting 10 to roughly 13,000 at the time, which was quite ironic because that prediction was made roughly in the bear market, ETH at 1,100. But here we are, and if we look that Ethereum is already trading fair value-wise at close to 5,000, that call that we now extended slightly lower to around 8,000 to 9,000 range is likely very feasible going forward. What does that mean, and what trajectory can we actually observe in the market for 2026? We know, of course, also Dominic outlined that fundamentally crypto is seeing more adoption than ever. Stablecoins are a very hot narrative on the blockchain in the crypto asset space. We know prediction markets, a true crypto adoption use case actually is really finding its mainstream narrative in place as of now. It might even turn into some professional or institutional hedging market soon, betting or hedging for economic events. And at the same time, we know that passive flows are coming, right? Be it the 401 case in the US, the traditional asset managers that not only open Bitcoin and crypto assets now for allocations, but they actively say 1, 2, 3, maybe even 4% allocations warranted, will cause tremendous inflows into the asset class. At the same time, if we look at institutional and sovereign adoption, right? We know Bitcoin sold off and a lot of crypto native players were very, very bearish in the last few months. But we also know the Abu Dhabi Sovereign Fund, the state of Texas, they all continue buying Bitcoin, or Texas even made the first Bitcoin purchase recently. And you might think, well, Texas is just US state, but if you look in terms of GDP ranking, Texas would actually be the 8th largest country globally. So steps like that really push the industry forward tremendously. Next up, we know also economic conditions are reaccelerating, liquidity is easing, and since we already come so far in this cycle so far for crypto, in our view it's highly likely that it will continue on the back of fundamental economic easing, so deregulation, tax cuts, rate cuts, and we also know the liquidity regime is not tightening anymore as of today. Last up, what do we think more concretely would happen in the year? So we of course think there will be new all-time highs for both Bitcoin and Ethereum, and that the crypto market will expand. But also we have definitely an eye of caution already on the midterms. There will be some volatility. We definitely think that Trump will run the markets hot coming into the election, but the odds, of course, of major volatility and a correction also rise substantially around that time horizon. With that being said, we don't need the laptop anymore. So far, fortunately. Thank you for your attention, but then I would also like to welcome two gentlemen on the stage, André from Bitwise and Sean, who flew all the way from California from the Bitcoin Standard Treasury Company. Thank you, guys. All right. So we have quite an exciting panel. I mean, you heard now the outlook from Bitcoin Suisse, but we want to broaden that, let's say, narrative and what we can expect in the year ahead with two very special gentlemen who came here a long way, maybe not so long for André, just coming a bit north. But we have, of course, two people joining the panel now next to Dominic and me who require no further introduction. We have André Dragosch, he's from Bitwise in Europe. He's heading the research department there. And we're happy to have him here today, especially because he's going to share his general experience or also his background in economics and also in financial history. And very interestingly, he actually has written a book which is called Exponential Gold, and I think that might imply Bitcoin. So very well welcome for André.
Thank you.
Then next up. Then next up, we have the CIO of formerly Blockstream, but now the BSTR, Bitcoin Standard Treasury Company, founded as basically the second largest DAT in the United States. Previously, Sean was also a fund manager for pension funds in the United States. We're happy to have him here. And most interestingly, the slogan actually of the BSTR DAT is, we're flipping the script and bringing the Bitcoin to the Wall Street. So warm welcome to Sean. Zoning out maybe very high level, if you now had to pass a review for the year 2025. Maybe André, starting with you, what were actually your highlights, but also maybe some unexpected downfalls that the year brought that you didn't have on the, let's say, bingo card for 2025, if you could enlighten us.
Yes, of course. Yeah, thank you for the invitation again. Yeah, I think we were very bullish going into the year for various reasons, because 401k openings up, ETF flows in general. We actually expected more flows this year than last year. Last year saw around $30 billion in net flows into global Bitcoin ETPs. We saw slightly less. We saw around 25 billion, which was still like positive, but still I think the market, I think decoupled at some point, right? Especially in Q4 because of this this huge number of long-term holders selling essentially. So that was not on our radar. We didn't think long-term holders would react to this kind of 4-year cycle pattern and would actually take profits above 100k already, because our price target was actually 200k. But that being said, I think what this has actually caused is significant undervaluation and mispricing, right? You mentioned 30%. It depends on what you're looking at, but I think relative to global money supply, we see relative undervaluation. Relative to gold, we actually see significant undervaluation. Relative to the global growth outlook next year, we see also significant undervaluation. Steepest mispricing since COVID, essentially. And also on an absolute basis, if you look at MVRV or any kind of metric for Bitcoin. So it was a bad year in hindsight, was more or less stable. Yeah. We expected a bull market, but that has actually caused lots of opportunities.
All right, so I just came in from Abu Dhabi, so it's like 10 p.m. there, and I've been hitting the hay like at 10 every night. Like it's kind of shocking. I was so tired. So I did have an espresso shot though to kind of get it going there. So I think definitely from the perspective of the U.S., definitely the big change is the dynamic with the administration in 2025, Jan 15. Having them come in and the Genesis Act getting approval. That's certainly huge. I'd say the second big thing would be the kind of this rise of the treasury companies, going back into April 25 with Metaplanet. I think that kind of kicked things off into high gear. I think obviously strategy had kind of paved the path there, and then when Metaplanet started showing such tremendous growth, I think it really got everybody's attention. I know it got our attention. We certainly pivoted to try to take advantage of it. The big surprise for me, I think, would definitely have been probably this October 10th sell-off with the Athena and the DPEG from the exchange that we're all aware of. So I think wiping out 20 trillion and 20 billion that day, which was pretty wild. Those are the things that definitely make me lose sleep at night. I was doing macro hedge funds before this, and since 1994 actually, down when they were actually open outcry in the pits. I was at the Chicago Board of Trade, so it'd be like I'll say it 500 at a quarter. We agree, So that's always the one thing. Like that was something that I think we maybe thought we had gotten past, but seeing that creep up again was definitely a bit unnerving and unsettling.
Yeah, I guess from my side, not too much to cover. You mentioned the most important topics. I guess on a positive surprise note, you could say that October 10th did also prove on a positive note that blockchains in the meantime became quite scalable, right? With these fee hotspots on Solana, for instance, there weren't very large congestion fees. It kind of proved that the system is more resilient and robust and maybe ready for more mainstream adoption. I guess biggest surprise for me was this decoupling to the downside, surprising to the downside, although like tech equities rallied so strong that we didn't see any like retail mania at all, that the institutional flows were so strong. And I guess like that both the ETF flows and the DAT flows now cooled off a little bit. It's just very organic, but I think nobody expected it to happen that early. I think the market front ran almost everybody.
So, André, you're working at one of the biggest global crypto index fund providers. Are you seeing any typical client behavior or maybe also inflow dynamics now that you think give a hint already at where we're heading in the next year?
Yes, very good question. So I start in general terms and then more specifically. So in general terms, what we saw this year is most flows accrued to Bitcoin, around 25 billion accrued to Bitcoin globally, right, into Bitcoin ETPs. We also saw that internally, obviously, so Bitcoin is also our biggest product. Second was, of course, Ethereum. It saw half the flows, which is incredible because usually so the relationship between Bitcoin flows and ETH flows 5-1, but we saw 2-1. So we saw significantly more flows into ETH. The other crypto assets saw like 10-1 flows. So there's Bitcoin 25 billion, crypto assets X ETH, all the other altcoins, single tokens saw 2.5. Right, so 10-1. That includes Solana, that includes XRP. Multi-asset and index funds, thematic funds included, negative flows. So I think what we also see internally is, especially with institutional clients, is there's not so much appetite for index products yet, like baskets, thematics. There's still so much demand for like plain vanilla Bitcoin and Ethereum and so on, like the blue chips. And I think you can also see it in institutional investor surveys. There's actually a shift happening from like diversified products to these single tokens, mainly Bitcoin, Ethereum, and Solana. Not so much XRP, not so much any other altcoin. These top three. We expect this to change with like newer investors adopting the asset class. So we actually bet on like the rise of index products next year, but that's what we're seeing. I just came back from a conversation with the UK asset manager, like big institutional asset manager, like 50 billion under management. And what did they greenlight? Bitcoin and Ethereum, right, internally. No index product, but of course, like the FCA has only greenlighted these two assets as well, so that's definitely an overlap. But I think even in the US, we see the same kind of behavior. We've just been approved by these wirehouses, Bank of America, both Bank of America and Wells Fargo. And yeah, same story, Bitcoin, Ethereum, right? So I think that's the current trend. And we talked about passive flows. I think that's definitely the case for this to be made there. I mean, there might be some nuance because of generic listing standards and all kinds of altcoins waiting for the SEC's approval. I think around 150 applications that are still pending, but I think that's definitely this case to be made for higher concentration.
So heading now also into this global easing regime, but especially after deregulation happened quite heavily and rapidly in the United States. John, you're a Bitcoin-only allocator. What do you think for the year ahead in terms of Bitcoin? What are the challenges, but maybe also opportunities going out of that regime shift now?
Yeah, so I think one of the things that definitely jumped out to me, if I put on a macro hat, would be that a lot of the other coins didn't make a new high. So while Bitcoin was making new highs, we didn't see a new high in Ethereum, for example. So that to me is a red flag, right? I mean, that's a problem for the ETH heads. What's working, what's not. I mean, I think that with Bitcoin, I actually don't take issue with any of the projections I saw. I thought they were relatively reasonable. I do think that big picture wise, in my sense is that we'll probably see a little retest here at the 105-ish, 100 area, where you broke down the support. And then it wouldn't surprise me if we go back and retest the lows to see how they handle it. And I think if you take those lows out, then you could potentially open the door into the 70s, low 70s. And then I think at that point you're still in a bull trend, right? You're still in an upward market, but you probably would wash out some of the weaker hands. So when I saw the slide on, I think it was 21 or what have you, that was showing that 500 billion had been distributed, my first thought was, okay, so the whales have distributed 500 billion, or monetized $500 billion of profits, and who's buying that? Well, I think, we've seen the surge in the ETFs and what have you, right? So it's retail, some hedge funds, some other investors. So that got my attention too. But in general, I think we're positive and constructive on Bitcoin. We wouldn't be surprised to see it kind of be in a sideways range and maybe retest the low, and then we'll see if it gets back on track. Longer term, going out, let's say 5 to 10 years, I would say we think that Bitcoin will eventually get to $1 million. And there's Stratosani, I think it's the name, from the Power Law on Bitcoin that does some great mathematical research on that. And I actually think it's kind of like, because as a trader, I love the Fibonacci's, I love the mathematics of trading. And to me, that it kind of makes a little bit more sense. I think a lot of people are like, oh my God, we're going to be $1 million in 2 or 3 years. Well, I don't know. It'd be great for me as a treasury company if we got to $1 million in a couple of years, but I don't expect that. I do think that the 180 target you guys have is pretty reasonable, and I think probably, I'd be pretty supportive of that.
Good to hear.
Yeah, I think so.
That's good to hear. We have the price target for the end, but I already see you're on board.
Yeah.
Speaking now maybe of what also André mentioned, right, there's very top-heavy or top-centered flows also into the large caps. Dominic, we know Bitcoin had still a very strong dominant hold position throughout the cycle so far, but we also see already the dominance is weakening somewhat. There's overweight inflows into Solana and also Ethereum so far, roughly by 3-1 by institutional allocators in the ETFs. What do you think for the year ahead? Do we actually see a broadening rally and also the rest of the crypto market picking up in 26?
Yeah. First of all, just briefly echoing what you outlined, I think that was quite interesting, and at Bitcoin Suisse we also somewhat learned the hard way that the markets needs time to digest this onset of crypto assets. So they took roughly a year to digest what Bitcoin ETFs, spot ETFs mean in the US, and now I feel like they are slowly warming up to ETH. So it's perfectly reasonable that by next year or the next 2 years they are becoming more fancy in how they allocate and in how deep they want to dive into the crypto sphere. I think we outlined earlier that we do believe that an application repricing is overdue. We see sticky user retention across many platforms. Obviously Hyperliquid, the biggest name to mention, but also Aave. If you think about the TVL, it's crossed into the top 50 by banks, by assets under management. It dominates the entire lending landscape, and it's just an incredibly important protocol, and it also now buys back the token with their quite sound revenue streams. So I think applications is something to look at in 26. Also perhaps still have a lot of tractions. If there comes a highly sophisticated on-chain options protocol, maybe also worth checking. And then maybe also looking back into 25, I thought it was quite pleasant to see that privacy picked up some attention, some focus again. We know the Zcash rally was very strong. In a context of AI, it's becoming more and more important that you also have some privacy features on chain. There's also very sound projects upcoming, such as Archium or Aztec and others. So this might be an area that I found fundamentally really interesting and also important as AI deepens its relevancy.
We now take what you just said and think about how, for example, ETFs have been very much in the spotlight so far. Do you think also that we now see a broadening institutional investor basis flowing into DATs or digital asset treasuries compared to the ETF, same as you anticipate the broadening in terms of altcoins and other narratives picking up in the crypto market in the year ahead?
Me? Here's the DAT expert. But yeah, I'm trying. I'm trying. I think in terms of DATs, I mean, super hot topic recently, especially as some were kind of offloaded some crypto assets in order to buy back their shares because they're trading below MNAV. Yeah, I'm not sure. I feel like the flows we saw, it might be these very strong flows, they might not be at that scale anymore in the next year. And I think now it's time for the sound DAT companies to step up and prove, such as MicroStrategy during the last bear market, that they can operate throughout the bear market, that they can get creative and find ways to buy more tokens in order to increase their crypto assets per share. So I think it will be more selective. It will boil down to the strongest ones, including hopefully your company, obviously.
I'll add a little bit to that if you don't mind. Yeah, so I think if like any digital asset, if you think about coming out of Silicon Valley, we kind of our game plan is that we think that there's going to be one or two winners, and just like there's one or two winners in search with Google, or one or two in shopping with Amazon, maybe Shopify is the second, or social.
Yes, I think yes, it's like the cleanest among dirty shirts, right?
Yeah.
But
Yeah. They'll gross line.
Exactly.
Take the least dirty shirt out of the hamper.
Exactly.
Yeah.
And so I think like countries like Japan, they're way worse off.
Yeah.
And I mean, if you look at illiquidity in the JGB market, it's at all-time record highs, right? We haven't seen like a big bull run in Bitcoin this year, but we have seen a bull run in Japanese bond yields, right? So it's up only. So I think at some point this will escalate and it will cause some kind of accident. And I think these kind of events, including the geopolitical risks, right? I think they are short-term bearish with Bitcoin, but like medium to long-term bullish. Why? Because geopolitical events, they imply more money printing, right? Fiscal expansion, the sovereign debt bubble essentially also implies more money printing, like QE. And so I think they will cause volatility in the short term, but it's definitely bullish medium to long term.
Thank you, André. So, as you said, it first must go up before it can go down. I see some guys already getting a bit tired and waiting for the liquidity event that we have outside waiting. So, two very short questions for the panelists and then we'll wrap it up. So, very briefly, each of you, what is one major catalyst or narrative that you think will drive 2026 for crypto?
So, I think you mentioned retail has mostly been absent this year, right? I think what many, and it's just a working hypothesis of but for me personally, but I think what's on my bingo card, positive bingo card, is essentially retail comeback. Because what we've seen, like you mentioned the labor market, like the labor market in the US has been like deteriorating, right? But like leading labor markets in the US, they actually imply that it's improving. Even like employment indicators are really accelerating. There's like an ASA staffing index, and it's a daily index of staffing activity among US companies, and it's really accelerating. And there's a funny correlation between US consumer sentiment, like the University of Michigan sentiment, and crypto asset sentiment. Like consumer sentiment in the US is at all-time lows or record lows, right? Crypto asset sentiment also very low, right? Where do we go from here? It's very asymmetric. It's most likely to the upside. And as I think the labor market improves in the US, I think there's a high chance that we see this kind of comeback, but it's still some kind of working levels or something.
Yeah, so I think that the cryptos definitely have the wind at their back with the money printing, and I just don't see that going away, right? And I think that's just you kind of have the wind in your sails, right? So that would be the big driver. I think that one thing is I in my former seat at Blockstream as the former CIO there, I always loved having the visibility into all the portfolio pieces that float through Blockstream, and One of them is the Liquid Layer 2 network, and you know, that network in the last, I don't know, probably 18 months or so, went from, let's call it somewhere around $1 billion of total value locked on there, to now it's over $5 billion of total value locked on there. And you know, it's open source code, there's no advertising, there's no marketing plan. You know, a lot of people I've talked to don't even know it's, you know, out there, right? But the thing is growing like a weed. And it's like, you know, it's got these things like, you know, small business loans and hash rate for mining and, you know, MicroStrategy stock and just all these, you know, things that are on there. So I think the tokenization thing is going to be really interesting to see how this blossoms.
Yeah, finally, after all these years, right, very high tokenization. I think on my side, I might go with the sovereign part, maybe more sovereign adoption of Bitcoin as a reserve asset. We know they are quite comfortable right now with like rotating out of US assets into gold, especially the BRICS bloc. I think at some point we saw early signs now with the Czech central bank and other countries like Luxembourg, which I mentioned earlier, with their sovereign wealth funds. I think this will pick up in 26. I think it's a reasonable call, and I think they are ready, despite being so conservative.
I got one little add to that, because that is an interesting point. You know, first over in Abu Dhabi, I think definitely I was there this last 10 days, and there's definitely still very strong interest from sovereigns. We had some folks from neighboring countries that flew in for the day to meet with us and then flew home. So there's definitely still, you know, strong interest there. The other thing I would say is in the U.S., you know, Adam and I did a panel at the State Association of California Retirement Systems in May of 2025. And I did a panel there in May of 2022, and the contrast was pretty stunning. We had maybe 100 people at the panel in 2022. This one was like standing room only, 650 people in there. You know, there's trillions of dollars of assets there. So I think that, and we had, I think it was like 30 or 35 questions from the audience, which was unreal. You know, it was more than the rest of the whole thing had at all the other sessions combined. So I think they're definitely sniffing around. I think they're definitely trying to figure out what's going on. I think they're definitely kind of like, maybe it's pivoted from, you know, do you get fired for buying Bitcoin? To maybe now it's like, oh shit, am I gonna get fired for not having the Bitcoin on there? You know, I think it feels like it's kind of definitely getting warm.
Exciting times ahead. So the question of all questions, no fundamentals or evidence, just what is the price target for Bitcoin and ETH in 2026? I have to give it to the round. Who wants to go first?
I think 180K is very reasonable. Our official price target is actually 200K. Again. So the reason behind that is I think most even quantitative models based on supply deficit, they actually imply around 170 as a fair value. But since we undershot all these fair values, right, I think there's a reasonable case to be made for like a kind of overshoot, right? Especially with respect to the macro. I think what the market will realize in 2026 is no recession, right? The market will realize, okay, global growth stays robust and actually re-accelerates because of the preceding number of rate cuts. And so I think there will be this kind of catch-up moment into risk assets, probably some kind of rotation from gold and generally from safe haven assets into risky assets, especially Bitcoin. And that's why I think, 200K next year.
Yours is 180, right?
Yeah, it would be weird if I deviate too much from our outlook. Read the outlook. I would just add maybe, I fully sign up with that. Like, I feel like some form of gold rotation into Bitcoin is overdue. If you think about the recent gold rally, like many portfolios that hold gold are right now overweight gold. And I think it's more than reasonable to rotate this overweight into the digital twin. And on the ETH side, I also think our call is quite reasonable. We know it's now the institutional platform of choice. We heard there are very strong institutional interest. Robinhood and its peers are launching institutional roll-ups. We now have staking ETFs. And maybe, yeah, if 25 was the year where the price surprised to the downside, 26 is might very well become the year that the price surprises to the upside.
Okay, I just want to make sure that there wasn't going to be a newer, higher high, so 200 here. So I would say I will go just a smidge higher, 210. On that.
The biggest bull.
Yeah, I want to be like a little bit more bullish than everybody else. You know, but I will also throw in that I don't think you see it below 65 if it gets pretty bad out there. If it does, you know, if there was some kind of panic sell or anything like that, I'd say 65 holds. So I'll go. That's my low, and I think the 180, 210, that zone is definitely very reasonable. I do think over the longer term, let's say 8 years out, I think you can make that strong case for $1 million.
Bullish times ahead. So big round of applause for our panelists and all the insights. Thank you everyone for showing up. As I said already, there is liquidity outside. Thank you very much for showing up to the event. You can find the report online. Also, happy upcoming holiday season, and we'll see each other again in a year's time latest to grade our homework and maybe come up with a new price target. So have a nice evening and see you outside.